when you get lower bond prices and higher yields, it competes with gold, so it hurts gold. So why is gold going up now, or treasury yields are going up? Well, because I think investors are worried, and this is not just a correction in the bull market. This is the beginning of a bear market, and that's why I think gold is telling us there's trouble in bond land. Wednesday, June 4th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, we're going to look at the bond market today. A lot of you know that the bond market is the most important financial market out there, not just for the overall health of the financial system, but for the overall health of the economy. And I'm sorry to say there's some really bad indicators out there that point to a huge crisis coming, and the crisis would be protracted. It wouldn't be like over a month and then it would be over. I think it would be a continuous crisis for the next 2 to 3 years. And it's not just me, of course, warning about that. Even Jamie Dimon has warned. He said it could be in the next 6 months to 6 years. But I'm going to give you my opinion on it. Before we do, just want to give a shout out to Dirty Men Safe, one of my affiliates. Dirty Men Safe provides underground safe solutions where you can securely store your valuables, be they precious metals, cash, jewelry, electronics, documents, even crypto passwords, if you're into that, with confidence. So if you want to find out more, there's a link below in the description. You'll get 10% off if you use my link. And talking about links, just wanted to give a shout out to Miles Franklin as well, my precious metals affiliate in the United States. They've just provided me with a new link, a Maneco 64 link. Of course, you can contact them as you have usually done. So back to the bond market, and yeah, the bond market was a market that I worked in when I worked in the financial sector. I started out in Switzerland for a small private bank, and my bosses, they were bond guys. And so even though we did deal in other instruments for our clients, the focus was bonds. So for example, before I started there, they sent me on a course in London, actually, a Eurobond course, to learn the mechanics of the bond markets, to learn the mechanics of bonds, how to calculate yield to maturity, duration, all those things that nowadays can be worked out through computers, right? It's a little bit like navigation. My dad used to use a sextant, but now you've got GPS. But anyway, so I'm very familiar with the bond market. I worked in it for over 20 years. And the thing with the bond markets is that it's where the smart money is. And I'm not trying to be arrogant here. It's where the major institutional clients gravitate to. That, well, by that I mean my clients or institutional clients from banks, other mutual funds, hedge funds. So, and I'm not saying they're all smart, but a lot of them are. And a lot of things happen in the bond markets, and it only translates into the stock market a little later. And if you notice on mainstream financial media and press, the focus is always on stocks for the general public. But the bond market is the most important market. So why is it so important, and why are rapidly rising treasury yields so bad for the markets all financial markets and the economy. What you need to understand is that if bond prices go down, the yields go up. It's very simple. Yes, and I know when I started out, I found it weird, but bear with me. So let's say U.S. Treasury issues a bond at par at 100 with a 5% coupon or interest or yield, and you buy that at an auction. But then the secondary market starts to worry about inflation rising, so people start selling the bonds because they want more than 5%. So the price of your bond goes from 100 to 95, and the yield, your coupon's still 5, but the yield is gone to 6 or 7. Which means that if the Treasury wants to issue bonds again, they're going to have to pay the new investors 6 or 7, and you're sitting on a loss on your principal. You're still earning the 5%, but you could have been earning 6 or 7. So let's go through the reasons why this is bad. Well, when Treasury yields rise, interest rates across the economy typically increase. So consumers face more expensive mortgages, auto loans, and credit card rates. Businesses face higher costs for financing investments, expansion, or operations. So you will see slower consumer spending and business investments. And, the economy could go into a recession because of that. There could be a slowdown in economic growth. What about pressure on the stock market or equities? Well, rising yields affect the stock market through several mechanisms. One of them is the discount rate effect. So what does that mean? Well, higher yields raise the discount rate used in valuing future cash flows, which reduces the present value of stocks, especially growth stocks that have long-term earnings projections. And it's also competition for capital. People might prefer putting their money into higher yielding treasuries than lower yielding dividends in certain stocks. Yes, there is the risk of you losing your principal in treasuries, but eventually they will redeem or pay you 100 at maturity. And yes, as Secretary of Treasury, Besant said, the Treasury will never default. Well, they will default de facto because they're paying with paper that has less purchasing power, but they will print as much as they have to pay you. So the other thing that rapidly rising yields do is that it tightens financial conditions because it affects corporate bonds, mortgage rates, auto loans, and other credit products. So as yields rise, overall financial condition tightens, which reduces liquidity in the system, increases default risk for firms that have borrowed too much or are over leveraged. So there isn't as much credit or currency flowing in the system, and it slows also capital formation. While the other big factor about rising treasury yields, and that's huge these days, and it's probably the biggest factor, is that it puts strains on government finances. Yes, Uncle Sam, of course, is running huge deficits, and we're going to come to some comments about the big, beautiful budget as well from some people. So it puts strains on government finances. The U.S. government must pay more interest on its debt. It's already paying over $1 trillion every fiscal year, more than the defense budget. So it's a vicious circle. It increases the cost of financing, federal deficit increases, they have to borrow more, and it crowds out other kinds of spending for the government. What about spillover into other parts of the world? Well, that will affect other parts of the world as well. They'll have the same problems because the US is the biggest economy, is the biggest bond market, and so it's not just a US problem. And I think it also points out to the fact that investors are not happy about policy, that there's policy risk, that there's inflation risk. And I think gold is also telling us that there's trouble in the bond market. In the past, gold prices would go up with rising bond prices and falling yields. Now it's completely changed. And we're going to look at that in a minute before we look at some comments, because it's not just me now who's warning about the bond market. And I've been warning for like 5 years because I thought the bull market we had since 1981 was going to end one day, and it has, in my opinion. But it's also people like Jamie Dimon. He warned, I think, last week that there would be a crack in the bond market. But he's also warning about the fact that he thinks stockpiling bullets, rare earths, is the thing to do. And instead of things like Bitcoin and paper assets. So when you have the head of the most powerful bank in the world, not central bank, but private commercial bank in the world, saying that, it tells me that he realizes that the age of financialization is over. And that was from 1981 to around 2020, 2021. We can debate on the dates, but it doesn't really matter now. So Jamie Dimon is saying that. So he said, it says here on this article, and I'll put it in the link below from Fox News, the United States should stockpile guns, ammunition, drones instead of Bitcoin. JP Morgan Chase CEO Jamie Dimon said Friday at the inaugural Reagan National Economic Forum, and I quote him, "We shouldn't be stockpiling Bitcoins. We should stockpiling guns, bullets, tanks, planes, drones, rare earths. We know we need to do it. It's not a mystery." These are all things that need natural resources, commodities. So he seems to be a lot more concerned about real things, hard assets. And then you have as well Elon Musk. I think he said yesterday, "I'm sorry, but I just can't stand it anymore. This massive, outrageous, pork-filled congressional spending bill is a disgusting abomination." Thomas Massie, of course, agrees with him. He says he's right. I saw Rand Paul agreeing as well with Elon Musk, and President Trump, of course, criticizing both Rand Paul and Thomas Massie. So my money is on Thomas Massie, Elon Musk, and Rand Paul. And they know what's coming. Jamie Dimon knows what's coming. The only thing now, of course, is when it's coming. And that's where we're going to come to the charts right now. So the first chart I want to bring up is a chart of the 30-year T-bond future. The 30-year bond, or the long bond as it's also known, is an indicator is a good benchmark for long-term interest rates or yields. Yes, you can use the 10-year, but I've used the 30-year. And you can see that from 1981 till around, around 2022, it was going up in this channel, upward trend line. That was the bond bull market. Yields, of course, were going down. So what I see here is that we had a consolidation here before we broke down below that trend line. I put like a little elliptical circle, and then it broke down. And since late 2022, we've had a consolidation. But the reason I've shown you this comparative chart is because it's got gold above. And if you notice, ever since we went below this channel, gold has started to go up. And that usually doesn't happen because, yeah, when you get lower bond prices and higher yields, it competes with gold, so it hurts gold. So why is gold going up now, or treasury yields are going up? Well, because I think investors are worried, and this is not just a correction in a bull market. This is the beginning of a bear market, and that's why I think gold is telling us there's trouble in bond land, if you want to call it. I'm going to bring you this chart of the T. This is the same chart of the T bond that I showed you just now, but it's just a T bond. So it hasn't been distorted because of the gold chart. So you can see those circles there, what I mean. Back in 2022, well, the big top you see there, it goes way above the channel. That was when we had the crisis in 2020 and yields collapsed. And then the Fed had to start doing QE, which is unusual. And they had to start to do it because volatility was so great. Liquidity vanished in the market. There was almost a collapse of the bond market. But since then, of course, yeah, yields have, the prices started to go down. And the first circle there is like a consolidation period after a big drop we saw from almost 200, well, above 200, excuse me, in prices to around just above 150. It consolidated for a while and then it dropped again. And most people probably thought, well, it's going to hold here, that trend line. It's always held since 1981, but it didn't. And that's when it dropped. And then it made a low in, I think it was, late 2022, but it also made another low in 2023. But it's been kind of holding there, and it's similar to the consolidation we had before. And the reason why I think this crisis could start anytime, could be today, could be tomorrow, could be next week, is that this consolidation is pretty long in the tooth right now. So we've had basically 2 years from 2021 to 2023 when the market really dropped. And now we've been consolidating for about 2.5 years or so. So I think we're very close. And you see there, I've compared what's happening now in the market to the Wile E. Coyote scene where he runs off the cliff. And for a second there, he doesn't, he hasn't fallen, but then he realizes, whoa, and then he drops. And I think that's the same thing that's happening to the T-bond future and all other bonds, of course, especially the long-term bonds. And I think maybe people at JP Morgan, the analysts there, have told Jamie Dimon about that. Maybe he's aware of technical analysis. I'm sure he is. He also mentioned that credit is really bad now. It's not the place to be. But he said JP Morgan will be okay. Is JP Morgan the bank that's been buying all the physical gold going into the US? It could be. It could be. Of course, he's not going to tell us that. So yeah. And if you look at the top we had in 2020, where the T-bond future went above 200, once it dropped, it took over 3 years for us to reach a low here and then consolidate. So if we do break the low of 2023 there, which is, I think it's probably, somewhere below 110. then it could be another 2 to 3 years of continued drop in prices and rise in yields. That's why I said the crisis, it's not going to happen in a flash. It's going to be protracted, but it's going to be very painful. Yes, the central banks, i.e. the Fed and other central banks around the world, they'll probably react to it. Of course, when it's too late, after the crisis starts, how would they react? Well, by printing trillions. Wouldn't that help bond prices rebound? Maybe more in the short end. Don't know about the longer end. They could stop this from happening. But if they do, that means something else will result from it. And that's an even faster rise in the price of hard assets and real things. Does that mean it's the end of the world? No. I think it means for us who can see this coming, who are aware of this, we can be better prepared. And of course, I'm not here to give you like all the solutions. I'm just trying to tell you, paint the picture for you. Of course, I've always been telling people that having gold and silver, physical gold and silver, having no debt is a good thing, because mortgage rates are going to go up as well. And if your mortgage or your loans are coming due, it's going to be almost impossible to refinance. I guess there are people there who have taken on longer term mortgages. They'll be okay, but it's just gonna like freeze everything. The housing market is gonna freeze the stock market, but I still think the beneficiaries will be gold, silver, commodities, mining stocks. So there is a silver lining out there. Markets come and go, cycles come and go. And yeah, that's the way I see it. So let's quickly look at where the markets are this morning. It's 7:40 a.m. London time. We've got spot gold at 33.56. It's up $3, so fairly quiet. High's been 72, low's been 46. Silver 34.45. Yes, we had a bit of a correction yesterday on Tuesday after the big run up in gold and silver. They still look really good though to me. Of course, silver, the key level is 35. Yesterday we saw it trade at 34.90. So we're getting close. The rest of the markets are really quiet. Like the stock market indices, futures are virtually unchanged. They're down slightly. So are the currencies, which is really weird. They're all like doing virtually nothing. So it's really quiet. And in terms of the 10-year yield and the 30-year, well, the 30-year is just below 5%. It's at 4.98. That's unchanged as well. So we're going to have to wait and see until a little later, until the US comes in, if things get a bit more dramatic or volatile. So with that, I'm going to wish you all a very good day. Take care. Bye.